Metro versus regional, what yield, what price point in today's. We're going to cover all these topics, and today's really about getting clarity to help you kind of build out your strategy and what fits you best. We can kind of open Pandora's box a little bit here, and there is actually not one size that fits all. It's really about trying to navigate and find out what type of investor you are, what you're comfortable with, or what your partner's also comfortable as well. And today's really designed in this to go through that in a further detail and see what we can find for yourself and give you a bit of clarity in that space. So firstly, we're going to go into the next slide here, and that's discussing metropolitan. So this is one, I guess, is from where most people are living, firstly. So most people are living in metro areas here. So some of the pros of investing in a metro area is familiarity becomes a big one for people. People love being able to invest in places they know they can either touch and feel or get to, or they know where they are on the map. So that's one of the pros for some people. If you're feeling comfortable to get in the market, you know, the biggest drawback for a lot of people is inaction. It comes the biggest loss of gains in my eyes, but that can be one. The next one, I guess, one of the benefits when it comes to the metro areas is proximity to utilities and amenities. It's no surprise really that, you know, you go into those metropolitan areas and you typically will have better utilities and amenities nearby, which can draw population growth into those areas. One of the other big benefits in these areas is that they offer stronger employment diversities. So you're not really going to see in these dense metro locations that the employment industry is just being heavily driven by one or two industries. You're not going to be seeing, say, in a really regional area where it's a mining town, all the income is sitting in there. That's not really going to happen in your metro area. So that can be a big tick because you're not going to have that volatility or risk factor sitting in a market like that. Then when we go to lack of new supply, so depending on where you're building, obviously, this is spoken in generalized terms, but in a metro area, typically we're buying in an established area. So the established area is built out, you know, all the vacant land has been bought out. So, you know, your asset becomes more and more scarce. It's all about supply and demand. That area may be increasing in demand, but there's no extra supply coming into the market. So that scarcity becomes really, really strong. Then when we go into the con side in this piece, so number one is the yield compression. And I guess why does that happen? So you get two kind of factors that happen here from the yield compression is firstly, unfortunately, as prices rise, you do tend to start to get your rent or your yields compress a little bit because unfortunately the $1 million home is not renting out for as expensive as say the $500,000 home. And that yield compression is based off affordability, but also it's based off the density in an area. You know, if you're buying somewhere, especially really close to a city location, you know, the density zoning on those regions can be quite high. So you could be having apartment complexes with hundreds, if not 1,000 people in terms of living in that area. So that extra supply puts pressure on that rent side, and it kind of just keeps the rental prices down or steady. It doesn't really allow it to fluctuate in that growth cycle. But then we go into one of the other cons, particularly more so your more expensive markets in the regional areas, but I still wanted to put that at a con here. So we're talking about your million or your multi-million dollar suburbs, and Melbourne and Sydney were a great example of this over last year, is those more expensive suburbs, they tend to have more volatility in terms of they can have the highest highs, but they can also have the lowest lows. And that can be a little bit of the case of your metro areas because they're not as affordable as other locations. We then talk about developers. So developers, you're another con here in a metro area. You know, your developers are very rarely going to be going out to your regional locations because for a few reasons, really, they don't have the access to materials, and they don't have the access to labor force, and nor is the demand there to be able to go out there and build, you know, 100 or 200 new dwellings over a 12-month period, or to erect a 50-story apartment complex and just smash out cookie cutter apartment after cookie cutter apartment. So those threats definitely exist in your metropolitan areas. And again, that new supply, even if it's an apartment, it can still suppress growth just a little bit. We then talk about high density and rezoning. So that is very common, more so in your metro areas. Your regional centres are a little bit more protective of their space, particularly their local council. So that rezoning, again, opens up the doors to more development. And then the other con is affordability. So affordability to get into some of these markets, you know, to get into $1 million property, you were talking, you know, maybe a couple $100,000 in terms of initial capital just to get into that. So they're the pros and cons. Again, which one suits you best? We'll get a little bit more into that further on into the model. The last thing we want to talk about in the metro area is kind of the gotcha, what to stay away from in a metro area. So in a metro area, I see a lot of people, they want the, I guess, all the things they love about a metro area, they want to be around, but then the thing they don't like is probably number one is the yield that they don't want to give up. So they can tend to get sucked into terrible assets in a metro area. So things like apartments, units, townhouses. We need to remember land is what is appreciating and the house is always depreciating. So you need to make sure you're avoiding those type of assets. If you are going into a metro area, you can't have both, okay? So just making sure that's a number one gotcha when it gets to the metro area. Next, when we get into the regional area, so on the regional side, you know, what are the pros and what are the cons when we're talking about a regional area? So probably one thing to, when we get into a regional area, is to weigh out what kind of regional area are we actually going to invest in. Are we investing in a regional town? So to me, a regional town is, you know, something maybe like a Ballarat, for example, or a Geelong, where they are a town of their own, but you still can commute to and from, you know, your Melbourne CBD every single day. So their economy isn't solely relying on the local economy. Where if we go to a regional centre might be something like Townsville, for example, or a Cairns, something of that nature, where nobody is commuting down to Brisbane, or not many people are commuting down to Brisbane or Gold Coast every day for work. All of their employment, education, everything is solely relying in that local centre. So it's just understanding what type of environment you're getting into. But when we walk through the pros and cons of a regional area. So the pro is typically you have high land to asset value in these areas. And the reason for that is you might be buying a property somewhere between $300,000 to $500,000. You know, the base cost for you to replace that building in a like-for-like component, you're almost getting the land for free. So the land to asset value ratio is quite high. You'll then typically get higher yields. Those higher yields will obviously come in part in terms of covering your outgoings, serviceability, etc. We then go through larger spikes. So the reason you'll tend to see larger spikes in a regional area is because those regional areas, they aren't getting the kind of trickle effect of government spend always, like you might see in your metro areas, which are kind of just projects chipping away, chipping away, chipping away. These areas will tend to get really large, big funding campaigns roll through. It might be hundreds of millions or $1 billion project roll through, but they don't come through every year. They come through in cycles, and those projects not only, you know, draw population growth to those areas, they also draw in investors, because investors know they're going to get those returns. So those spikes can be quite volatile, particularly if you're catching them early, which for an investor, that's really what you want to be targeting. You want to be targeting these areas which have high compounding growth early on, because that leveraged asset is continuing to build yourself along the way. The other benefit of investing in a regional area is you do typically have lower vacancy rates. And the reason you will have lower vacancy rates in your regional areas is because typically you don't have your developers coming in, punching out home after home after home. So as an advisory level, it's not uncommon for us to be buying in areas where the vacancy rates historically have been under 2%, but in the current market, it's closer to 0.5% vacancy rate. So this supply and demand thing, we've always got the demand in our favor. We've got this working for us in the background. And then another one, which is kind of overlooked, is the stronger negotiation power. You know, in a metro area, you know, days on market tends to be a little bit, or much shorter, to be frank. So, you know, they know another person's going to come to an open home, another person's going to come to an open home. Sometimes in these regional centres, the days on market can be, you know, close to 3 digits. So it's not uncommon that they only get a handful of people come to the first open home, and that might be it. So your leverage and in negotiating on that property to secure a property under market value can be a lot stronger in a regional centre than it is in a metro area. People tend to hold out a little bit longer in your metro areas. But then we go into the cons. So one of the cons is that it can be hard to access. So what I mean by that is some people will like the accessibility to their investment property. If they're hands-on investors or they're a handy person, they want to get out there all the time, that can be a negative in that regional area. The next one can be lack of employment diversity. So basically the opposite of what we went through in the metro area, where you want to be avoiding. This is something that we don't go anywhere near at an advisory level, but ideally you really need to be avoiding these areas that they've got a large, I guess, backing of employment coming from one or two sectors. There's probably only one exception to that rule, is if you're buying in a town and the town's got a lot of people, let's say, employed by a state-funded hospital. That would be about the only one exception we want to that rule. But again, we want to make sure that that can be a negative on the regional side. Then we also talk about population growth. So sometimes these regional towns or centres can have slow to stagnant population growth. Now this isn't always a negative as long as the demand drivers are there, particularly in the vacancy rates, but that can be a negative one. And then also the days on market. So kind of counteracting the stronger negotiations there, you are typically going to have, when it comes to selling your property, longer days on market. You're not going to be getting dozens and dozens of people rocking up to your open home, so the selling cycle can be a little bit longer. I guess one of the biggest got-yous in the investment side for a regional area is absolutely making sure you're buying in the right street and suburb in that regional area. Particularly in regional towns, it's even more important to be buying in the right area, because locals know where these not so good suburbs and not so good streets are, and they will become more and more of an avoid area for the true locals over time. We want to make sure we're buying in the right streets in those areas. Next part we want to get into is we want to talk about yields versus price point. So what to target, what are you sacrificing, which one suits you best? The cash flow component we'll walk through in a little bit if that is part of your strategy, and also is how many assets do you want to be actively managing as an investor. So we want to break that down just a little bit and go further into that, because that can become a big component of your strategy. So for me, what we're kind of walking you through here is a bit of a cash flow analysis and I guess an equity return on a property in a regional area versus a metro area. So we can kind of see the figures here. We're working on a 6% interest rate, 80% lend, 37.5% tax bracket, $3,000 of depreciation on both properties, and the same growth rate. Everybody's probably watching this model and talking about which area gets you more capital growth. Well, I'm here to tell you, it doesn't matter. So you might be walking away a bit disappointed trying to get an answer. It does not matter whatsoever. You can pick segments of time. Markets are cyclical in terms of, if we wanted to go over the last 35 years, well, regional centres have outperformed Melbourne and Sydney quite strongly, and other parts of the country, the exact same story. But again, they move in different ebbs and flows of one another, just similar to how shares and property tend to move. They tend to be doing a dance with one another, just sometimes it's a little bit of different times. So it really comes down to personal preference. When we go into the numbers here though, what we're looking at here, what you will typically find in your regional centres, firstly, you're going to pick it up at a lower price point. So we can see here in the regional side, we're picking this one up for $500,000. On the right side, we're picking up this metro property for $600,000. Now, some of the differences may be is that firstly, your council rates can differ from area to area. So we've got the similar council rates here in this example. Your water can differ from area to area. The biggest one is insurances tend to be higher in regional areas, because regional areas typically may be more impacted by things like bushfire, flood, cyclone, and other kind of natural disasters. So they will typically come with higher insurance premiums. Also, typically, though this can be a bit more state-based, and there's always the odd exception here or there, typically speaking, you will find slightly higher property management fees in your regional centres or some rural centres. And the main reason being is because there's longer commute times for these property managers. They could be driving 30, 40 minutes from property to property. Or when you're getting into those metro areas, a property manager might have 10 units or apartments in the same block. So you'll tend to get slightly less property management fees in your metro location. But we can kind of see here, there's not a huge difference in return, and in each location, we do have a bit more net growth on the metro property, but that's purely based off we're going off a $600,000 asset versus a $500,000 asset. And kind of again, talking here, this example's on interest only or principal and interest. We will cover this one off in a further terms of whether it should be principal and interest or interest only. Ultimately, that's going to be dependent on your current situation. If you've got your own home, you've got a mortgage on it, you probably should go interest only, but that's also going to be complex based around your servicing component. But we can see here in the principal and interest and the interest only component, the only real difference is going to be you will probably actually get a slightly lower interest rate on a principal and interest repayment, but you'll also have more, you've got that principal to cover. So that's another one that we want to be wary of there. The next one we want to cover off is higher yields versus lower yields. What are the pros and cons on each one? So we've got our high yields. I consider high yields being properties 5% plus. A lot of people will tend to ask, well, you know, is there a negative going for your properties that are above 7% or higher? So I guess to cover that one off quickly, in general, your properties that are 7% or higher, if they're most likely going to be either in the wrong type of location, and what I mean by that is they're surrounded by public housing or other non-desired areas, so potentially they're in a flood or cyclone area, so they're coming with good yields, but they're coming with that is also heavy insurance premiums. Or they're the wrong type of asset. You got a duplex or a townhouse or something like that in an area which is going to get you low capital growth, but somewhere between the 5 to 7% yield is where a lot of investors tend to target. But the benefit of targeting a higher yield, firstly, is you get to cover a lot of your outgoings. So that's a really big positive. And by being able to cover a lot of your outgoings, skipping ahead a step here, you're going to be more likely to hold on to that asset. If we go back to the leverage earlier on, we saw that the real benefit comes with time. So it is far easier to hold an asset which you can hold for a longer period of time because of the cash flow component being taken care of, as opposed to a property where you've got to be chipping in away. Another added benefit is that it can help with your serviceability. And then finally, one of the negatives can be that it can increase your taxes, but I think I should preface here because there's a bit of a misconception with investors regarding this one. So when a property is increasing your taxes, it's not actually taking money out of your pocket. What we mean by that is, let's just say you've got a property and it's making you an extra $10,000 cash in your hand each year. Absolutely, you have to pay tax on that. That's taxable income. If your tax bracket is 40%, you've got to pay $4,000 of that. You're still left with $6,000 in your pocket. On the flip side to that, if you've got a property that's losing you $10,000 a year and you are in the 40% tax bracket, well, the tax man might give you a rebate of $4,000, you've still lost $6,000. So that's a big misconception people have out there, which kind of leads us now into the lower yielding properties. So for me, lower yielding properties isn't anything under 5. It's probably more properties 4.5%, 4% or under. The first one can be, it can impact your savings and your lifestyle. So if you are somebody who's in a position where they need to manage their weekly cash flow, they don't have a lot of expendable cash coming in each week, then potentially a lower yielding property isn't going to suit you, particularly if it's going to stop you from going on holidays and doing all the kind of day-to-day things you want to do. The second one is that it will reduce your serviceability. We see a lot of investors who have purchased properties, particularly properties off the plan, where they were sucked in by depreciation. They get stuck on 1 or 2 properties, and that is mainly because they've gone out there, they've bought negatively geared properties, and I'm talking hundreds and hundreds of dollars a week, and they've ruined their servicing. And the only way that they can move forward is to go a step back and offload one of those properties. So that's one of the other negatives of a lower yielding property. The third component, without going too much into detail of this, because this will be covered off in the accounting segment, but it can be harder to maintain in a sophisticated structure. So if you got a property in a certain structure type and it needs to be running not so negative, that can be one that might not align with that. And one of the benefits, I guess, whichever way you want to look at it, is the tax deduction benefits. And again, if you're buying a lower yielding property, the tax deductions can be impactful in terms of, particularly if you're a high income earner on that higher bracket. If you've got a property with a lower yield, but it comes with the benefit that it's in a location that you're happy with and also offers depreciation for you without sacrificing some of the key fundamentals in terms of when picking a property, which we'll get into some other modules. Then that might be an option for you. Then the next segment we want to get to is the price points. So lower price points versus higher price points. So again, for me, I would consider a lower price point a property under 550,000, and then we get into the higher price points. I've got 550,000 here, but it could be potentially higher than that. So I guess firstly, the benefits of the lower price point property. So you're going to get an affordable entry point. You know, as an advisory level, we're able to pick up properties anywhere from $300,000 up. But they also, that means you need a much less deposit to be able to purchase that property. We see clients come on purchasing a property within $60,000 to $70,000 of savings or equity in their name. So that affordable entry point, getting in the market earlier, going back to that leverage segment, you know, you don't have to sitting 3, 4, 5, 6, 7 years on the sidelines to be able to get into the market. That's one of the huge benefits that the lower price point property can offer you as well. The second one is less volatility. So going back to a point earlier is your more affordable properties tend to be almost insulated from the weather elements that happen on economic front. You know, if interest rates go up, they go down, they don't really pull back much at all because these properties are typically priced very close to the rent line. So in terms of people renting are almost paying in line with some of these areas in terms of someone having a mortgage. So they become really, really affordable and you don't see those big price fluctuations. Also from a serviceability level, if we compare that to say a multi-million-dollar area, there's only a certain segment of the population that can afford a multi-million-dollar property versus an affordable property under $550,000. There's a large number of people in that mix that can afford it. And also it's where a large catchment of first home buyers sit. So people looking to get into the market, that really sits there. The third benefit is you can diversify your risk. So you might be someone that wanting to come in and buy $2 million or $1 million worth of properties. You're able to go out there and purchase 2, 3, 4 assets potentially and diversify that risk over many different properties and many different locations. So that can have an added benefit. You're then able to purchase outside of your area. So sometimes where you're living isn't always the best place to invest. So this can be seen as a pro or a con, but you're able to invest in other areas across the country rather than be stuck in your own location. And the final one is the biggest benefit really is the high land to asset value ratio. Touching on this one again, you're buying properties where most of the value is sitting in the actual land component itself, as opposed to the actual dwelling itself. And then when we compare that to the higher price points, so higher price points come with higher entry points. So again, $1 million property, you're probably getting close to $200,000, $150,000 to get into that property. Some of the benefits is that you might be able to purchase in a location that is familiar to you. So if you're somebody that, you know, needs to be in and around you or a location that you're aware of, that might be an added benefit to you as well. And then the final one is less assets to manage. So I have this conversation with various clients across the board in terms of determining what type of investor you are. If you're a time poor individual and, you know, you don't have the time to have 5, 6, 7, $500,000 properties in your portfolio, and it's really hard to even just get you in your first meeting, let alone your property manager, etc., trying to reach in contact with you, then potentially getting yourself into a higher price point properties because the cash flow component isn't important to you, it might suit you better. But so that's again where you've got to weigh up and balance. Is it the cash flow or the value of the properties? Which one suits you best? Is it a time issue, etc.? So that's a bit of the rundown in terms of the higher price points versus lower price points. The last thing we really want to touch on is, you know, what is the best strategy that's going to suit you as an individual? So this is a very complex one, and it's not something that we can really bespoke to an individual just in a video module. But what is really important is for you as an investor to go away and self-reflect. And what I mean by that is if you're investing by yourself, or if you've got an expert guiding you along the way, the real kind of key main points you need to cover off is what are you or you and your partner comfortable with purchasing? If you're somebody who's not comfortable purchasing in a area you've never heard of, then potentially you should be sticking to metro locations. On the flip side, if you're somebody who's only caring about the returns and or the cash flow component because managing your weekly budget, well then potentially higher yielding, lower price point properties are going to suit you both. But the biggest takeaway I want you to walk away with today is, what do you need to put in place to take action? Because the biggest problem that a lot of investors have, this is where they spend most of their time, debating amongst themselves what's their overall strategy, what is the price point, the yield, and they give themselves almost every reason analysis paralysis before taking action. Ultimately, it's the asset that you purchase that's going to get you the result. If you're buying the best performing asset, it's going to create options for you. If you buy a property and it goes $200,000-$300,000 in value over a couple year period, well, fantastic. You have now created options for yourself. You can either extract equity and move into another property. You can sell down that property and upgrade your home. You could sell down that property and pay off your mortgage quicker. You could have a raft of opportunities created to you, but that only comes from action. If you're sitting there with analysis paralysis and not taking action, you won't create options for yourself. So I hope you took something away from this today. The next I'm going to go through is going to be a budgeting tool. So in that tool, I'll walk you through kind of how you can plan a weekly budget. You can kind of see your yearly forecast, and that will also assist you with what we've gone through today to kind of determine which strategy might suit you one better. But we'll talk to you in the next. Thanks again.